Well, hello and welcome to all my loyal subscribers here on YouTube. Thank you for joining me this week. So let's have a look what is going on with the overall market. Pretty much exactly what I said would happen last week. We have had the markets move down again, like I ultimately believe. I'll just go to the SPY here quickly. Is that we will go back to where we were prior to COVID, around 337, 340 in that zone on the SPY. That's where I think we're headed back down to. There is a pivot where we are right now at 357. I spoke about that last week as well. We may get a little short-term bounce, but I think ultimately we're moving back down to 340. That would be my viewpoint as to where the target is on the overall market. But if we go back to the SPX, same thing obviously. Now we can see right now we've got a bear flag here. So we've got actually a bearish charting pattern. This big pole move down, sideways consolidation. We've broken out of that bear flag and we look as if we're wanting to go more to the downside. Now, the opening range that we set from last time is now bearish, obviously. We've moved down. We've taken out this pivot low, okay? We have broken down, formed a bear flag, and broken below that as well. So certainly some bearish developments there. But we've got a new opening range that we reset on the first trading day of the month. We're resetting that tomorrow after the first market session in the week, like tomorrow. So we have to wait for that to actually get clear confirmation. But if we have a look here, let's have a look at the US dollar. Still very much in an uptrend. Yes, it's pulled back a little bit, but that's only because it's hit the upper trend line here. Still very bullish. If that continues to go up, the market's still going to continue to move down. The combined put call ratio, the 10-day moving average, is at 1.09. That is actually bullish. The trend at 1.03 is neutral. The skew at 123 is neutral. The actual SPX put call ratio is at 1.41. That is bearish. The amount of stocks above their 50-day moving average is less than 12%. That is bearish. If we have a look here at the stacked moving averages here, with the SPX, the overall market, we've got the bear flag that I've just told you about, and we've broken down below that. That's stacked bearishly on the weekly. How do we know that? 89 on top, 55, 34, 21, and 8. When they're stacked in that sequence, 89 on top, 8 on the bottom, that is a downtrend. So certainly a downtrend there with a bear flag that's broken to the downside. And on the weekly, same thing, stacked bearishly. And on the monthly, not only are we below the 8, 21, and now we're also below the 34, so that's bearish as well. If we have a look at Goldman Sachs, so goes Goldman Sachs, so goes the market. That has a bear flag forming on it, and it is stacked bearishly. The transports, which can predict where the market will lead or move to by several weeks, that is stacked bearishly with a potential bear flag forming there as well. Junk bonds and high yield bonds are stacked bearishly. You can see that there with a bear flag forming also in high yield bonds, stacked bearishly. So we've got a lot of bearish indicators right now, and it does appear as if the markets want to continue to move down at this point. However, we do have the non-farm payroll coming out this Wednesday. If we do get a less than expected number, so the number is not as good as what everyone had anticipated, I think that'll be a bullish catalyst, and you'll actually see the markets rally. Why? Because if the employment figures are not as strong as what the Fed thinks, then maybe they won't be as hawkish. Maybe they won't raise rates so rapidly, right? That sort of thinking will probably lead to the markets to move higher if we get a less than expected, not an absolutely disastrous report, but a less than expected, right? That's what I think will more than likely happen. Now, as far as the overall markets go, just to keep everyone in context here, it's the worst start to, or the worst month, should I say, in 20 years. We're down 9.5% this month, 9.5. Now, keep in mind, we were down 4.5% last month. So in the last 2 months, we've been down 14% on the SPX. So certainly a lot of bearishness. Now, if we have a look here at the VIX, let's have a look at it. There it is there. Now, the VIX right now has had the last 5 trading days above 30. That's fairly elevated, okay? And it's not above the upper Bollinger Band, though. If we do get it outside of the upper Bollinger Band, that's when you're looking for the markets to have a short-term bounce, like rally. Okay, but we haven't quite seen that yet. So what I think is probably going to happen, we'll see another move down below that 357 level on the SPY. The VIX will then move, so it's above the upper Bollinger Band. Okay, say 38, 40, something like that. Have a big move up. Then once you get it above the upper Bollinger Band on the VIX, that normally allows the markets to then rebound. Right? That's normally what will happen. So I'm looking for that last little burst higher in the VIX, looking for the SPY to go down to that, break that 357, go down to around 340. Don't know whether it happens this week or not, but that's what I'm looking for ultimately. So they're my overall views on the market itself. Let's have a look at some positions that we've been putting on. I showed you guys this one last week with the SPY. What we did is we set up a put debit spread where we bought the 335, sold the 345 for the 18th of the 11th expiry. We bought that for $270 a contract. And right now it's worth $3.38 a contract. So we're up 25% in a week. Pretty bad week. Certainly the worst month in 20 years, and we've just made 25% return in a week. Now I'm holding that position for now. I am holding that position. Now, a new position that you could potentially look at is this one here. I'll just show it to you. So if we have a look here, TWLO, okay, tech stock don't do well in high inflationary environments when they're raising rates, and this one has certainly been moving down and more down. It's below the 50 EMA and the 100. The 100 is below the 50, and the 50 EMA, the yellow line here, has been acting as a resistance level for quite some time. The on-balance volume shows you clearly it's in a downtrend, and the selling pressure is exceeding the buying pressure. Okay, so that's another thing that's going on there. If we have a look at that stock, it's below the 200, the 100, 50, and the 21. So they're all bearish signs for the overall stock as well. And if we look at the overall trend on a daily, it's in a downtrend. On a weekly, it's in a downtrend. And on a monthly, it's in a downtrend, right? So all the major time frames are in alignment with where the stock is moving, which is to the downside. And we are looking for it to continue to move down. Now, right now, it's at 69.14. All I need the stock to do is get below 69. That's right, just 14 cents from where it is. Not a big move, right? Don't have to take a lot of risk. I've already got that bearish position on the SPY, okay? So that's what I'm looking for, it to get below 69, okay? So what I would do is set up a put debit spread by buying the 70 put, selling the 69, only costing $50 a contract. Ultimate goal, stock to move 14 cents lower, below 69, and close below there come the third Friday in October, right? So just 19 days from now. Maximum profit here is $50 a contract. How much does it cost you to get in? $50 a contract. So it's a 1-to-1. But if we put in the stop at 25 cents, now our risk is 25 and our potential profit is 50. So I'm not going to put a profit taker on this one. So that will then create that asymmetrical risk that we need, which is a 2-to-1. We can make twice as much, $50 per contract, as what we're risking, $25 a contract. Okay. Now, if you had 10 contracts, obviously it's going to cost you $500, and your risk would be $250, right? With a potential upside of $500. Okay, but it's a good asymmetrical opportunity. It doesn't have to move far for you to become profitable, and I think that one makes some sense. So this week, let's see what non-farm payroll is on Wednesday, and we will take our new opening range then as well. That will help us next week, and we will look at some new opportunities for next week. But right now, it looks as if we're going further to the downside. All right, my friends, my name's Sean Allison. Thank you very much for listening. All the best, and bye for now.